Today, we're going to peel back the layers on something that affects pretty much everyone: insurance pricing. Now, if you're looking at this from an investor's point of view, you know that understanding why a policy costs what it does, well, that's absolutely key to evaluating the entire industry. We're going to move past this simple idea of just getting a deal and really look at the mechanics behind the risk, the structure, and where the real value lies.
All right, so here's what we're going to cover. First, we'll bust the myth of simple discounts. Then, we're going to break down 3 key ways that value is actually created: the family floater, the group plan, and employee insurance. And we'll wrap it all up with a final takeaway that's really designed for understanding the business side of things. Okay, let's dive right in.
So, let's start with a really fundamental question. In an industry that's literally built on complex risk calculations, what does a discount even mean? You know, this is where what we expect as consumers really clashes with how the industry actually works.
I mean, it's just a simple truth, right? Whether you're buying groceries or a new pair of jeans, we are all hardwired to look for a bargain. We want to feel like we're getting a good deal. But looking for a discount on insurance, that's a whole different kind of hunt.
And this slide just lays out the core difference perfectly. On one side, you've got the retail world. We all get frequent sales, coupons, you can even haggle a bit. But then you have insurance, and it's a world of regulated pricing and fixed premiums. You can't just walk up to your agent and say, "Hey, can you knock another 10% off for me?" It just doesn't work like that.
So why is it so different? Well, here's the crucial part. The pricing isn't just made up. The entire industry is heavily regulated, and that's to make sure that companies are stable and can actually pay out claims. That framework leaves very, very little wiggle room for the kind of discounts we're used to seeing everywhere else.
So you might be asking, well, where do any price differences come from then? Usually they're pretty subtle, and they're structural. You know, buying from an agent offline might cost a little more because they have more overhead. But there's this really powerful force at play called channel conflict. Insurers simply cannot offer a massive online discount because it would completely undercut their own agents. They have to keep all their sales channels happy, so prices tend to stay pretty close together no matter where you look.
And this really shows you the reality of the so-called online discount. When you do find one, it's almost always less than 5%, and often it's only for the very first year. It's a small little incentive, not some fundamental change in the product's cost. So, if the real value isn't in these tiny discounts, where is it?
Okay, let's move on, because this is where things get interesting. This is where we find our first real structural discount: the family floater policy. But as we're about to see, in insurance, every discount is really a trade-off. It's all about accepting a different kind of risk in exchange for that lower price tag.
So first off, what is a family floater policy? It's pretty simple. It's a single policy that bundles multiple people, usually you, your spouse, and your kids, under one contract with one single shared pool of coverage. You just pay one premium for the whole family.
Now, the appeal is obvious, right? It is almost always cheaper than buying a separate individual policy for every single person in the family. So if you're a young family on a budget, this looks like a huge discount. And hey, it's convenient. One policy, one premium, one renewal date to worry about.
But here is the trade-off, and from an investor's perspective, this is the heart of the product's design. The coverage is shared. So if one family member has a major health issue and uses up the entire sum insured, well, the rest of the family has zero coverage for the rest of that year. The discount comes directly from that shared risk. It's a calculated bet by the insurer that not everyone is going to need a lot of care in the same year.
Now let's look at a completely different model: group plans. These aren't something you can just buy off the shelf. For insurers, this is a whole different business strategy. It's built on scale, but it also creates a very different set of dependencies for the person who's actually insured.
So what is a group plan? Think of it like a custom-made suit, not something you just buy off the rack. It's a special contract created for a specific group of people, like, say, all the account holders at a certain bank, or all the members of a professional club. These are not retail products, they're negotiated deals. And the process is pretty straightforward. An insurer finds a group, they create a custom plan just for them, and they give a price quote to what's called the master policyholder. That's the bank or the company that holds the relationship with all the members. Then that master policyholder offers the plan to its people. The individual member, they have very little say in the actual terms.
The big upside here is scale. It's just way more efficient for an insurer to sign up thousands of customers all at once. that efficiency gets passed along as lower premiums, which creates a discount when you compare it to a retail policy. And the features can be customized to fit what that specific group might need.
But the risks? The risks are significant. The price isn't locked in. If the group has a bad year with a lot of claims, the insurer can just raise the premium for everybody next year. And, this is the big one, your coverage only exists as long as that master policyholder keeps the deal going.
And that is the stark reality of a group plan. If that bank decides to switch to a different insurer, or if the company you work for goes out of business, your policy can just evaporate. You are a member of a group, not an individual policyholder in the way we usually think of it.
Which brings us to the most common group plan there is: employee insurance. For millions of people, this is their main, sometimes their only, health coverage. So is it this amazing perk, or is it really a business decision that's more about cost-cutting than it is about comprehensive care?
For some people, it is an absolute godsend. I mean, if you have a pre-existing condition that would make getting a regular policy really hard or expensive, employee insurance might be your only shot. Plus, it often covers you right from day one, no waiting periods. And the best part? The company usually pays for most, if not all of it.
But you have to look at the incentives here. An employer's main goal is usually to check a box and control their costs, not necessarily to give you the best coverage on the market. And that can lead to really basic plans with a lot of exclusions, a lot of fine print, all those little ifs and buts that are designed to save the company money.
So here's the bottom line. The policy is tied directly to your job. If you switch jobs, if you retire, if you get laid off, your health coverage is immediately at risk. And that is a huge vulnerability, especially if your health has changed while you've been working there.
And this is exactly why it's so often recommended that you have your own personal policy as a backup. Think of it as a hedge. It's a safety net that you own, you control, it's totally independent of your employer, and it protects you through all those career changes and all the way into retirement.
All right, let's wrap this all up. From an investor's point of view, the biggest takeaway from all of this is pretty simple. When you hear the word discount in the insurance world, your first thought should immediately be, okay, what's the underlying risk structure that's making this lower price even possible?
And that leads us to our final question for you to think about. As you're analyzing the insurance sector, which business model do you think is more resilient for the long haul? Is it the traditional model of selling individual high-margin policies one by one? Or is it the model built on the huge scale and lower margins of group plans? You know, there's a trade-off there too. And understanding that trade-off, well, that's the key to understanding the future of this whole industry.